Hello and welcome. Today we're going to tackle a really important part of India's new Income Tax Act 2025, and that's Section 59. It deals with a very specific but increasingly common situation: how we tax royalty and technical service fees that are earned by non-residents who have a business presence right here in India. So let's dive right in. So, to really get a grip on this, let's start with a practical question. Imagine there's a company based in the UK. They have an office in Mumbai, and from that office, they provide tech support to their Indian clients. The big question is, how does India tax the income they make from this, especially under the new 2025 Act? Well, Section 59 is where we find the answer. Here's what we've got on tap for this explainer. We'll start with the basic challenge. Then we'll decode Section 59 itself. We'll explain what net income basis really means, walk through a case study, focus on the compliance side with Form 24, and finally, wrap up with some key takeaways and common issues. All right, first things first. You might be wondering, why do we even need a whole section just for this? Well, it all comes down to a fundamental challenge in cross-border taxation. Here's the puzzle we're trying to solve. You have a foreign company earning money from India, let's say through royalties or what we call fees for technical services, or FTS. Now, if that company also has a physical presence here, like an office, it just wouldn't be fair to tax their total revenue. Why? Because they have real expenses in India to earn that money. The law needs a fair system to tax the profit they actually made in India. And that leads us directly to the hero of today's story, Section 59 of the Income Tax Act 2025. This is the new framework specifically designed to solve that problem of fairness. So Section 59 lays out the exact rules for how to calculate this income. Now, for all the seasoned professionals watching, this will probably ring a bell. Section 59 is essentially the successor to Section 44DA from the old 1961 Act. The core ideas are the same, which gives us some really helpful continuity between the old and new laws. Before we go any deeper, we absolutely have to talk about a key concept, the permanent establishment, or PE for short. You can think of this as the anchor for the whole section. In simple terms, a PE is a fixed place of business. It could be an office, a branch, a factory. It gives a foreign company a real, tangible business foothold in India. It's what connects their income to the Indian tax system. So how do you know if Section 59 even applies to your situation? Well, it boils down to a simple 4-point check. First, the taxpayer has to be a non-resident. Second, they're getting paid in the form of royalty or FTS. Third, and this is the absolute key, that income has to be effectively connected to a permanent establishment in India. That means the PE's assets or activities were a major factor in earning that income. If all those boxes are ticked, then this income gets taxed as regular business profit.
And that brings us to the biggest advantage of Section 59, which is taxation on a net income basis. So what does that actually mean? Let's break it down.
Think of it this way. The tax law has two main paths: presumptive schemes, which are often used when there's no PE. Just take your gross income and apply a flat tax rate. It's simple, but it can be harsh. But Section 59 lets you take the other path. You start with your gross income, and then you get to deduct the legitimate expenses you incurred to earn it. You're taxed on your net profit, which is almost always a much fairer deal. Okay, so what kind of expenses can you actually claim? Well, you can deduct costs that were spent wholly and exclusively for the PE's business. You can even include a reasonable portion of your head office's general admin costs. But, and this is a big but, you have to be very careful. The absolute crucial point is that only expenses that are attributable to the Indian PE are allowed. The burden of proving that connection is on you, the taxpayer. Theory is great, but let's see how this all plays out in the real world. We're going to walk through a case study with some actual numbers to make it concrete. Let's circle back to our company from the beginning. We'll call them UK Tech Ltd. They have their permanent establishment in Bengaluru. In a given year, they earn 1 crore rupees in fees for technical services. After going through their books carefully, they figure out that the expenses they can directly attribute to their Bengaluru operation come to 60 lakh rupees. So here's how the math works. We start with the gross FTS of 1 crore. From that, we subtract the attributable expenses of 60 lakhs. That leaves us with a net taxable income of 40 lakhs. This amount is taxed as profits and gains of business or profession, or PGBP. Now, using an illustrative tax rate of 40%, the tax comes out to 16 lakhs. Just think how much higher that would be if the tax was on the full 1 crore. Now, getting the calculation right is critical, but it's only half the story. You also have to properly document and report it. And that brings us to a compliance step you absolutely cannot afford to miss: Form 24. Let me be crystal clear about this. If you compute your income under Section 59, you are required to file Form number 24. This isn't optional, it's mandatory. It is an audit report certified by a chartered accountant that confirms your calculations and your expense allocations are correct. And again, for those who've been around a while, this is simply the new avatar of the old Form 3 CE. So, a very straightforward but important question: who exactly is on the hook for filing this form? Well, the net is cast pretty wide here. It applies to non-resident individuals, it applies to foreign companies, and it applies to any other kind of non-resident entity. The trigger is always the same. You're earning royalty or FTS from India, it's connected to a PE here, and you're using Section 59 to calculate your income. And of course, the most practical question of all for any compliance form: when's the deadline? The deadline here is tied directly to your income tax return filing date. You have to furnish Form 24 at least 1 month before the due date for filing your main tax return. What that means in practice is you can't leave this to the last minute. You need to plan ahead to get that audit done well in time. To get ready for the audit and file Form 24 smoothly, your accountant is going to need a good amount of paperwork. We're talking complete books of account just for the PE, the legal agreements behind the royalty or FTS, all the supporting invoices, and most importantly, a detailed breakdown of how you allocated your global and local expenses. Believe me, solid documentation is your best friend here. All right, we've covered a lot of ground. The law, the math, the paperwork. Let's pull it all together now and look at some common tripwires that you really need to watch out for. Here are some of the most common mistakes we see. First, incorrect expense attribution, either being too aggressive or just plain sloppy. Second, simply forgetting to file the mandatory Form 24, which can cause major compliance headaches. Third is having weak documentation that just can't stand up to scrutiny. And finally, a big one, not checking the relevant Double Taxation Avoidance Agreement, or DTAA. It's a tax treaty that might actually offer you a better tax rate, so you always want to compare. So let's recap. Here's your go-to checklist for Section 59. 1. It's for non-residents with a PE in India earning royalty or FTS. 2. It's your ticket to being taxed on a net income basis. 3. Keeping detailed, separate books for your PE is non-negotiable. 4. Filing Form 24 is mandatory. And 5. Remember that this whole thing stands or falls on having a proper, logical, and defensible way of attributing your expenses. And I want to leave you with a final thought to chew on. In today's world of digital services, remote work, and cloud computing, does the old idea of a fixed place of business still make sense? You have to wonder, how will tax laws and the very definition of a permanent establishment have to evolve to keep up as our business borders continue to blur? And that's our look at Section 59. I really hope you found it helpful. Thank you so much for watching. If you got some value out of this, please do like, subscribe, and share it with anyone else who might benefit. And just a quick reminder, this video is for educational purposes only and is not professional advice. Tax laws can be very complex and they are always changing. So please consult with your professional advisor before taking any action based on this information.